Welcome everyone to our discussion of the answers to our test review for test number 3. We have an XYZ publicly traded company. They have the following balance sheet. This was given to you at the end of 2015. You're going to make the journal entries for the transactions for 2016. So this is our starting point. Then our journal entries. Here's the various transactions. There are what we might for routine journal entries, and then the ones that are more complicated that the accountant needs some help with. So first, and I suggest you put these in T accounts like I'm showing you here, in order to make sure you keep track of all those. Of course, the balances from last year go in the T accounts first, then record sales, debit, accounts receivable, credit, sales, depreciation expense, debit, depreciation expense, credit, accumulated depreciation. This is ignoring any new assets, okay, and it's equal to the tax depreciation, so we don't have any difference between tax and our book depreciation for these assets, for this expense. Amortization is $3,000, debit, amortization expense, credit, either the asset or the accumulated amortization, whichever you prefer. This is also the same for tax purposes. You can see that we're going to have a tax issue later on, and we need to know that these two are the same for both on the income statement and the tax return. Interest expense. This is the interest expense paid, but not considering the convertible bonds. It's paid in cash, so you can credit cash and debit interest expense. Wage expense, debit, wage expense, credit cash. Insurance includes $2,000 paid, that's cash, credit cash, debit, insurance expense. And the other $3,000 is expired, so you're going to credit prepaid insurance and debit insurance expense. Now, this life insurance, you'll remember, is a permanent difference for later on when we start talking about our taxes. We collected $275,000, debit cash, credit accounts receivable. We paid off some of our bills, debit accounts payable, credit cash, income taxes payable from the balance sheet. We paid last year's taxes. We made a payment on the note payable, debit $15,000, note payable, credit cash, and then we bought $191,000 in inventory. That would be a debit to inventory and credit to accounts payable. And then we're going to adjust any inventory to $56,000, credit inventory and debit cost of goods sold for that. So getting to the transactions that require a little more thinking here. Stock options, fair value of $4, 1,000 of them vest over 4 years. So the total value of this is $4,000. Fair value of the options in total. Since it was the beginning of the year, we have a full year of this, so the amount vested or the amount that's earned for the first year is $1,000 or 1/4. That's going to be a debit to compensation expense and a credit to additional paid in capital, okay, for $1,000. Nice easy math. 300 shares on the open market for $20. That's a debit to treasury stock and a credit to cash for 300 times the 20. Issue convertible bonds. New bonds that can be converted into stock. Convertible at a rate of 20 shares per bond. Interest is accrued but not paid. That means we're going to have to calculate interest, we're going to debit interest expense, and credit interest payable. So if we start on May 1st, $200,000 is going to be debit to cash and a credit to the bonds payable. Interest is going to be 3% for May, June, July, August, September, October, November, December for 8 months out of 12, so 8/12 of 3%. So 2% on those is going to be your interest, $4,000 debit, and interest expense, credit, interest payable. Here's the interest payable part. Also, leased equipment started on July 1st, $3,000 per year. So this is harkening back to our lease scenario. We're only going to make one payment per year of $3,000 starting on July 1st. So we're going to take the present value of that. So our leased asset present value, 7%, because down below it tells us that we are going to use that as explicit rate. 10 years, $3,000 plus the $500 bargain purchase, and then you put the 1, make it beginning of the period, and you get $22,799. You could round it to $22,800. That's going to be a debit to lease asset and a credit to lease payable. All right. That's going to then be depreciated because that's our asset. On our income statement, it's going to be depreciated using straight line for 10 years. And for tax purposes, it's going to be used makers for 7 years. All right. So there's going to be a difference there. That's our first temporary difference for tax purposes. Resold these treasury shares. Remember, when you debit the cash for the 25 times the 100, but when you credit treasury stock, you credit it for what you paid for it, which is $20 times the 100 shares. The difference goes to additional paid in capital. All right. Issued stock only dividends when the price is $25. This is a large stock dividend, and so it is simply the number of shares outstanding, half of that times the par value. Now it says to adjust option. What that means is when we look back at this convertible bonds, now they're convertible to 30 shares, exercisable at $30, which is market value. Okay, but that doesn't happen till November 15th. And we leased a building. So this here was a finance lease. That's why we're going to depreciate. This is going to be an operating lease because we're only going to have it for 5 years. You still have to do the present value and record a lease asset and lease liability. That lease asset, okay, if you look at the payments, 7%, 12 periods, 60 payments, 2,500, 0 and 1. That's $126,991 is your lease asset and your lease liability that regard. So initially, no difference in how we account for it. And then we need to know the shares outstanding so we can calculate and get our dividends paid 50 cents a share. All right, some other things. Average price of shares $24. Incremental borrowing rate, like we pointed out, is 7%. Now we're not going to use the half-year convention. We're going to actually figure out the months. So first of all, show your journal entries. You can use the T accounts to show them. And then also the entries needed for the transactions the accountant needs help with, a more complicated one. And then we need income statement. So if we're looking at our income statement, our income statement should start out like this: sales, cost of goods sold, depreciation, lease expense, insurance. Lease expense for 2 payments, $2,500. Remember, the lease expense is just a flat amount per month. Interest expense, compensation expense. All right, and we get to $44,767. That's pretty straightforward so far, as long as we got all of our entries there and depreciation. All right. So we then have to look at our tax expense, and we go back to our week that we learned about taxes and deferred taxes. We start with income before taxes. We have a one permanent difference, life insurance, adding it in. That's $46,767. Then we have two temporary differences, compensation expense and depreciation. Compensation expense is going to be added because that's not deductible on the tax return, but it is on the income statement. But on the tax return, we're going to have a higher depreciation, given this calculation, the cost of the asset times the amount from the maker's table, okay, and then the difference between that and the depreciation using 10-year life, straight line, okay? So our taxable income with those temporary differences is $45,649. All right, our cumulative difference on the compensation expense is $1,000. So our deferred tax asset is $350, and our cumulative difference on the depreciation is this as well, because there's nothing from the previous year. So our deferred tax liability is $741. So the journal entry to record this deferred tax asset is a debit to deferred tax asset and a credit to tax expense, just the opposite for the deferred tax liability. So that leaves us with our tax expense as $16,368. All right. Remember, the taxable income times the tax rate is where we start with, and then we adjust for these two, as we learned before. So our that number transfers back up to our regular income statement, $16,368. We get our net income, earnings per share, and diluted earnings per share. Now, how did we get our WASO for shares? We started out with 10,000. We bought back 300, and then we sold 100. So there is your WASO. Here's the number of months: January through March, April through October, and then November, December. Multiply them out, add them up. There's your WASO for the basic. All right, your diluted, you're going to have your options that affect your 300 all right, turning to our options, this number has changed a little bit. The average options outstanding for the period, if you think of it as 250 for the year, has been earned. That's 1/4 of the 1,000. Then the average is 125. They buy back 104 shares with the proceeds, and so it only adds 21 shares to our diluted earnings per share. Our adjusted net income, we add back the interest we would have had on only on the bonds, the $4,000 times 65%, and so our ending EPS is $1.50. New diluted WASO, new adjusted net income, and then you get $1.50. So our income statement would end with that. Statement of equity, you should see all the things we've already considered: sale of shares, purchase of shares, stock dividend, all those shown as changes in statement of equity. Net income, balance sheet looks like that. Calculates out no payable, interest payable, all of those things would tie back to our T accounts, and then our cash flow, starting with net income. We add back depreciation, take out our non-cash expense, or add back our non-cash expense, changes in accounts receivable, inventory, prepaids, accounts payable, taxes payable, interest payable, and deferred tax liability. Financing, we pay off the note payable, we purchase a treasury stock. There was no investing activities, new convertible bonds, sale of treasury stock, and dividends, which was $73.50. So our started $4,000 in cash, and now we have $232,000 957.